Donald Trump issued an executive order telling the Fed to consider giving the crypto industry master accounts. This is absolutely a huge move, especially when the crypto industry has had a contentious relationship with the bank regulators over the past half a decade. We're going to talk about that and everything else in the news today. Let's go. What is up, everybody? Welcome to the Daily Wolf here on Yahoo Finance. I'm your host, Scott Melker, also known as the Wolf of All Streets. You can find me right there at Scott Melker on all of your favorite social media platforms. Most of you probably still use Facebook, if we're being honest. I don't even know if I'm at Scott Melker on Facebook, so don't look there. I haven't checked into that place in a very, very long time. But on Twitter and Instagram and the ones that actually matter, Scott Melker, the Scott Melker. So we have a lot of news to unpack today. I would say that maybe the executive order is the biggest news that we've had in months. But first, we got to lay out a little timeline for how it happened, because it's absolutely unbelievable. Now, obviously, on Friday, we had Kevin Warsh approved. We'll get back to that in a second. Then on Monday, of course, we had this piece of news right here. Elizabeth Warren presses OCC on approval of special charters for crypto companies seeking to act like banks while evading bank rules. So this was on Monday, May 18th. She sent this to OCC Comptroller Jonathan Gould. Now, she was accusing the OCC of illegally approving 9 national trust bank charters for crypto firms since December 2025. She says that these are a violation of the National Bank Act, and she specifically named Coinbase, Ripple, Paxos, BitGo, Fidelity, Circle, Crypto.com, Stripe, and Protego. She says that the activities that are at issue here are staking, lending, stablecoin issue, custody, and payments. So she's obviously extremely angry, as she always is. In fact, we had reporting from the Springfield Gazette here, and I want to show you how they reported on this story. Old lady yells at crypto. You guys remember the meme, right? The old man from The Simpsons, old man yells at cloud. Well, in this case, that cloud is crypto, and any time that this old lady gets a chance to yell at crypto, she takes that opportunity. Obviously, we know that she's not going to be able to do anything here. I told you that her legislative record is about 0 and 380. She's never passed anything. That's like if the 2008 Detroit Lions kept losing for 20 seasons, right? This lady has never passed anything successfully, but she loves the opportunity for a press moment, and that's what we got. But the big story isn't the fact that she filed this on Monday to the OCC, which is just one of the bank regulators. The bigger story is the executive order that came just one day later as Trump came over the top. Fact sheet. President Donald J. Trump, I just laugh at fact sheet, the way that we start these things. Fact sheet. President Donald J. Trump integrates financial technology innovation into regulatory frameworks. So the day after Warren went nuts to one regulator, Trump came out over the top to the Fed and all the other regulators. So he directed 6 regulators, Treasury, Fed, OCC, FDIC, NCUA, SEC, and CFTC, to review and streamline fintech crypto rules, and then went on to specifically tell the Fed to evaluate master account access for non-bank crypto firms. And all of this is to be done within 120 days. Now, let's go back to that timeline, because this executive order could have likely come out at any time during the Trump presidency. He wrote a whole bunch of them famously about the crypto industry right when he came in. And in the previous administration, we know that under Biden and during the Gensler era and with contentious relationships with the regulators, that we had something called Operation Choke Point 2.0. During that time, the crypto industry effectively had no access to banking rails, not only just to the Fed, but they had to use intermediary banks for all their banking services, and they could cut off the tap anytime. We saw it repeatedly, especially after FTX. I remember days when you'd go onto Coinbase and they would tell you that you needed to wire your money into a new account or withdraw to a new account. It would be some bank you'd never ever heard of, because all of their banks were selectively getting shut down for participating in crypto services. When Silicon Valley Bank failed, we saw that Signature Bank was murdered on a Sunday in broad daylight when they still had billions in reserves just because they banked the crypto industry. That was also courtesy of one Elizabeth Warren. But now with Operation Choke Point 2.0 ending, Trump is trying to give the crypto industry direct access to the Fed. Why does that matter that it happened this Tuesday? Because we got Fed Chairman Warsh on Friday. Why does that matter? People don't realize, I think, we all get lost talking about whether Warsh is coming in to be a sock puppet for Donald Trump to lower rates, even in an environment where many people think that he should hike. But the other side of the Fed's job is to regulate the banks. And maybe that's more important than what they do with interest rate policy, because now you have someone who understands the crypto industry, who is working directly with Donald Trump in an unofficial capacity as a non-governmental agency, because the Fed obviously is independent. Wink, wink, independent Fed, right? Who can now pass this through. So I do not think it's a coincidence that we got Chairman Warsh coming in, Daddy Warsh bucks, on Friday. And now with a friendly Fed chairman, we have the crypto industry likely getting access to master accounts. It's been a long road for the crypto industry. My friend Caitlin Long has been fighting the Fed on this for years on behalf of Custodia Bank. She asked for a Fed master account for a fully reserved bank, no risk, and was rejected. She sued the Fed. She lost. This is vindication that banks like hers and all banks and crypto exchanges and companies will likely start to have access directly to Fed rails. JP Morgan and friends are going to absolutely lose their minds over this. They've had the privilege of direct access to the Fed exclusively for the entirety of history. Well, sorry guys, there's a new kid in town. It's the crypto industry, and we're coming to eat your lunch. Absolutely a massive story on the executive order. Of course, it is not law yet, but likely could be. At the same time, we actually had the SEC wants to let newly public companies raise cash instantly in its biggest rule change in decades. So while this is unrelated, it happened the exact same day. The SEC looking to massively loosen the rules around IPOs. This is not specific to crypto, but anybody who's been paying attention knows that there are many companies in the crypto industry that are looking to get public in the coming months and years. And this law, along with everything else that's happening at the SEC, is going to make that much easier. Very clear that the Trump administration and his regulators are crypto friendly, working hard to open the doors of government before we see regime change. Now, the next story is more institutional, but all of these are obviously related because we're talking about the big banks. Here we have some news from Morgan Stanley from my friend James Seyffert, the oracle of ETFs over at Bloomberg. This morning, Morgan Stanley submitted an amended filing for their Solana ETF. Ticker will be MSOL. We don't have a fee yet. So this is absolutely mind-blowing to me. Morgan Stanley was largely sidelined with the crypto industry just a few weeks ago. And then all of a sudden, they issued a Bitcoin spot ETF that came in at 14 bips, cheaper than everybody else. This was the first commercial bank to do so. They're not generally an ETF issuer. Now Morgan Stanley also coming in with a Solana ETF and a Solana staking ETF, the first bank to do that. We do have Solana ETFs from other issuers, of course, but you have to assume they're also going to come in with a cheaper product here. And a staking ETF means effectively that you'll be able to get a dividend because they'll be able to stake into the network and earn a yield for holding Solana on behalf of the ETF. And there's another side to this story, which I find very, very interesting, actually, because as Morgan Stanley comes in heavy into the ETF space, where many would say they don't belong, and into crypto in general, we have a story of companies going the other way. Trump's Truth Social pulls Bitcoin ETF application from SEC review. So Trump media had 3 ETFs that they were looking to get approved. Bitcoin ETF, and a crypto blue chip ETF, which included Solana, XRP, and others. Now, they said this was because they were moving from the 33 Act to a 40 Act framework. But my friend James Seyffert over at Bloomberg said the same thing I did. He said, it doesn't make a ton of sense to me. What's really happening here is that Truth Social, who is down to $405.9 million in Q1 alone, mostly on unrealized losses on their crypto holdings. It's not been going well for this Trump organization with crypto, unlike their others. But it's probably because they know that they can't compete or come in cheaper than Morgan Stanley. Once Morgan Stanley came in with a Bitcoin spot ETF at 14 bips, nobody else is coming in this market to compete. No smaller entity is going to be able to. It is an absolute wrap for Truth Social and their ETF dreams. Morgan Stanley is going to heavily win this race from the bank side. Now, the next story we have actually has 3 very confusing parts from the great state of Minnesota. First of all, I've been telling you about the ongoing drama with Bitcoin ATMs all over the country. Well, Minnesota has gotten in line and banned crypto kiosk fraud in Minnesota. So they actually just banned the ATMs. They didn't ban fraud at all. And the ATM is just a tool being used by fraudsters who will use other tools. So it's absolute nonsense that you would ban these, especially in light, as I told you, of the fact that the Clarity Act actually protects these federally and sets rules in place for people to use them safely. So it's just the next state in line to ban these completely nonsensically. But on the flip side, we have this one. Panel OKs allowing banks, credit unions to offer cryptocurrency accounts. And Waltz actually, to his credit, signed this one into law. So now even credit unions and all banks locally in Minnesota are able to custody crypto assets, which is actually very forward thinking for this state, and to offer these. So they're actually ahead of the feds on all of these. And it seems like we have a pattern here of them trying to basically just say, hey, we have the state's rights to do these things, and the federal government's not going to tell us what to do. Not a surprise coming from Tim Walz's Minnesota. But then the bigger story, Minnesota becomes first state to ban prediction markets. So we've seen battles over prediction markets everywhere. They have outright banned prediction markets here in Minnesota. Of course, the CFTC under Trump immediately sued Minnesota the same day. That is the, I believe, 5th state total that's being sued by the CFTC in this turf war over whether states or the federal government will be the ones to regulate prediction markets. But Minnesota's all over the map, man. Make up your minds. Sometimes they're pro-innovation, sometimes they're anti-innovation. But like I said, it seems like the real story here is that they're exerting their power over the Fed at states' rights and trying to make sure they know whose turf this is. Now, interestingly, on the same day that they banned Polymarket and Kalshi, Polymarket announced a massive partnership with the NASDAQ to list private company contracts. So we're getting prediction markets to private companies at the same time that we have them being banned by different states. We're all over the map, as is the case with any new emerging technology and product. And we're going to have to see how all of this shakes out in the future. Now, I have a little final segment here. It's not a specific piece of news, but I want to show you 3 separate pieces of news that kind of fit into it right here. And I like to call this one, How Not to Invest. That was really good timing. I mean, that was how not to invest right there, like as the words rolled out of my mouth. You guys get a raise. That was great. So all 3 of these stories are coming from our good friends in Asia. Now, the first 2 are from South Korea, where anyone who tracks trading volumes or leverage or basically just degenerate gambling knows that these guys are on an entire other level, probably gals as well. I don't want to be sexist. These guys and gals over in South Korea. But often the crypto exchanges in South Korea that you've never even heard of in the United States are eclipsing Coinbase, and the biggest exchanges here is by many multiples in volume, especially with leverage. These people love to gamble and they love to trade. And now their retirees are liquidating their savings and insurance policies to chase SK Hynix and Samsung rally. When asked about it, these are largely retirees, literally, or people heading into retirement who are like, forget the safe stuff. I got to get in on this AI trade. And not only that, they're trading on leverage ETFs, giving them exposure to the AI trade while these things are at all-time highs. Now, I think we can all agree how that's likely to end. And the next story here, this should be illegal. A South Korean funeral company, rest in peace, invested its customers' money in a leveraged crypto ETF and lost $33 million. They took $44 million of customer funds, prepaid customer funds, and put it into T-Rex 2X long BMNR ETF. So listen, the crypto media was reporting this as the South Korean funeral company lost a bunch of money on Ethereum. What they actually did is they bought a leverage ETF on BMNR, which is already effectively a leveraged treasury company on Ethereum. So it's like 4 or 5x leverage on Ethereum, if not worse. And they took prepaid customer funds and YOLO'd it into this and lost almost everything. How not to invest. And finally, this amazing man, 88-year-old Japanese ex-pet shop owner, built a $14 million fortune buying stocks. He turned $387,000 into $14 million. But the real story, could have saved himself a lot of time. If he had simply bought the S&P 500 in 1986 and done nothing, he would have over $21 million today. So Bloomberg reporting that he made $14 million from $387,000, trading every single day for decades. He could have done nothing and made $21 million, which is why I tell you to just buy Bitcoin and chill. We have a lot of stories today that we'll be tracking. Obviously, the legislative, executive order, and regulatory sides will be stories for weeks to come. That's all I got for you today. Be back tomorrow for the next Daily Wolf. Peace.